benefit do they offer for investors?
Well, it's really that the starting benefit is diversification. So if you put all of your money, all of your eggs into one basket, everybody knows that's basically a silly thing to do. You get what happens when you get market downturns in equities, like a GFC, or the 5 or 6 or 7 downturns we've had since that you'll have too much volatility in your portfolio. So people are saying, well, I panicked at the GFC and I put all the money into a bank account, and now the money's starting to come out of the bank account, but where do I put it? And so XTBs, senior bonds, are one destination for money in a bank account where the returns are now 1 point something or 2 point something. And this gives you a range of very senior debt of companies ranging from 2.75% up to 5% returns, and then beyond that is into equities and ETFs and hybrids and other more risky investments. So really the benefit that it's giving you is a solid base for your portfolio that will not move around with equities. So when equities over the last, the September quarter is the worst quarter in about 7 years, and equities of course plummeted, hybrids fell after them because they're supposed to do that, whereas senior bonds stayed there as a sort of stable base, as cash would in a bank account, but the returns there are lower because it's even safer in a bank account. And so corporate bonds are one step up in risk, because the risk of Qantas is not the same as the risk of a bank, so you get more, but it doesn't move around a lot like equities and hybrids and more things like structured products, etc., and derivatives.
Okay, and how can they work themselves into an investor's portfolio?
Well, I think a lot of investors are constantly rebalancing their portfolio. So there are certainly a lot of self-managed super fund have got an awful lot of their portfolio, 26, 27, 28% sitting in cash, and that's either in a short-term cash management account or a 1 year, 6 month, 3 month term deposit. They're now thinking about, well, what do I do with that money, because the term deposit rates are falling, the cash management rates are falling. The opportunity is to say, well, do I take it and put it all back into equities? In other words, I'm going to go all back into equities again. I think that's a thing of the past. I think everybody now, all advisors, all brokers as well, realise you need a diversified portfolio. So the opportunity is for Australia really to look at fixed income anew and say, well, it isn't all about just for the wholesale market or just some managed funds. There are now opportunities to actually get into the same brand names, Woolworths, Telstra, BHP and other top 50 companies which we've covered, but at a senior debt level. So I've got equities, so I think Woolworths is good for the money. I'm backing it in an equity point of view. Therefore, I think it'll pay me back. Therefore, I'm willing to put money into Woolworths debt, essentially. So that's what an XTB is, giving you exposure to Woolworths borrowings. So there's a stable part of my portfolio. It's never going to turn into, a bond is never going to be worth 5 times what it's worth today. Like a mining explorer might discover gold and be worth 5 times, but it similarly doesn't have any of that risk. So it's money in, money out, coupons along the way, stability, good income, predictability. If you've got school fees coming up in 3 years, or you're going to be getting into a property investment in 5 years, you can say, well, I believe these particular issuers are going to be around in 5 years, therefore I can plan exactly my outcome. So I know exactly what I'm going to get in 3 years, 5 years, subject to those companies meeting their obligations and not collapsing, which is a pretty low risk with top 50 ASX companies. But that allows you to plan into the future to say, I want $100,000 in 3 years and $200,000 in 5 years. You can't really do that with equities. You can't really do it with totally diversified investments, but you can do it with individual bonds, because you know they're going to pay 6%, 6%, 6%, and then my $100 back for every bond. So that predictability is something that a lot of people are looking for. So it gives a new tool that hasn't been available to investors. Previously it was lots and lots of equity and equity-like investments on the ASX and not a lot of debt. The ASX put government bonds on there, which are lower yield, and now we're putting on senior corporate bonds, which is just a step above government bonds in terms of returns without the risk you get when you suddenly move into equities.